Identifying a successful forex trading strategy is one of the most important aspects of currency trading. In general, there are numerous trading strategies designed by different types of traders to help you make profit in the market. However, an individual trader needs to find the best forex trading strategy that suits their trading style, as well as their risk tolerance. In the end, no one size fits all. In order to make profit, traders should focus on eliminating the losing trades and achieving more winning ones. Any trading strategy that leads you towards this goal could prove to be the winning one. How to choose the best forex trading strategy. Before we proceed to discussing the most popular forex trading strategies, it's important that we understand the best methods of choosing a trading strategy. There are three main elements that should be taken into consideration in this process. Time frame. Choosing a time frame that suits your trading style is very important. For a trader, there's a huge difference between trading on a 15-minute chart and a weekly chart. If you are leaning more towards becoming a scalper, a trader that aims to benefit from smaller market moves, then you should focus on the lower time frames, for example from 1-minute to 15-minute charts. On the other hand, swing traders are likely to use a 4-hour chart, as well as a daily chart, to generate profitable trading opportunities. Hence, before you choose your preferred trading strategy, make sure you answer the question, how long do I want to stay in a trade? Varying time periods, long, medium, and short term, correspond to different trading strategies. Number of trading opportunities. When choosing your strategy, you should answer the question, how frequently do I want to open positions? If you are looking to open a higher number of positions, then you should focus on a scalping trading strategy. On the other hand, traders that tend to spend more time and resources on analyzing macroeconomic reports and fundamental factors are likely to spend less time in front of charts. Therefore, their preferred trading strategy is based on higher time frames and bigger positions. Position size. Finding the proper trade size is of the utmost importance. Successful trading strategies require you to know your risk sentiment. Risking more than you can is very problematic as it can lead to bigger losses. A popular advice in this regard is to set a risk limit at each trade. For instance, traders tend to set a 1% limit on their trades, meaning they won't risk more than 1% of their account on a single trade. How to develop a forex trading strategy. When choosing a forex trading strategy, it helps to be aware of what type of trader you are and what types of strategies exist. However, it is not as simple as selecting a single trading strategy, as traders can choose to employ a single strategy or combine several. Firstly, you must define your criteria for selecting a forex trading strategy. You should analyze factors that can help narrow down your search, such as how much time you can set aside to trading forex, what currency pairs you want to focus on, the size of your position, whether you're going long or short. Learn how to short pound sterling. Forex trading strategies. The following forex trading strategies are utilized by traders to provide structure to their trading efforts. These strategies are not specifically designed for forex markets but are rather general strategies that can be applied to all financial markets. The strategy you decide on will correlate to the type of trader you are. Open an account to start practicing your forex trading strategies via spread bets and CFDs. Forex scalping strategy. Forex traders who prefer short-term trades held for just minutes, or those who try to capture multiple price movements, would prefer scalping. Forex scalping focuses on accumulating these small but frequent profits as well as trying to limit any losses. These short-term trades would involve price movements of just a few pips, but combined with high leverage, a trader can still run the risk of significant losses. This forex strategy is typically suited to those that can dedicate their time to the higher volume trading periods, and can maintain focus on these rapid trades. High volume trading periods include 8:00 a.m. to 12 p.m. GMT when both New York and London exchanges are open, 7:00 p.m. to 2 a.m. GMT when both Tokyo and Sydney exchanges are open, 3:00 a.m. to 4 a.m. GMT when both Tokyo and London exchanges are open. The most liquid FX currency pairs are often preferred as they contain the tightest spreads, allowing traders to enter and exit positions quickly. Some examples include Australian dollar to US dollar, 0.7 pints minimum spread USD, 0.7 pints minimum spread JPY, 0.7 pints minimum spread. Forex day trading. If you want to trade for short periods, but aren't comfortable with the fast-paced nature of scalping, day trading is an alternative forex trading strategy. This typically involves one trade per day, which isn't carried overnight. Profit or losses are a result of any intraday price changes in the relevant currency pair. This type of trading would require sufficient time to research and monitor the trade, as well as a good understanding of how the economy could affect the pair you're trading. If major economic news were to hit that day, it could affect your position. Find out more about forex day trading. Forex swing trading. For traders who prefer a mid-term trading style where positions can be held for several days, there is swing trading, which aims to make a profit out of changes in price, by identifying the swing highs or swing lows in a trend. Although this strategy normally means less time fixating on the market than when day trading, it does leave you at risk of any disruption overnight, or gapping. Learn more about swing trading strategies. Forex position trading. The most patient traders may choose the forex position trading, which is less concerned with short-term market fluctuations.